Welcome. In this video, can XPR coin make a new AT8th? We will analyze it. Don't forget to subscribe, like, and please watch to the end to understand. Such technical analysis breakouts typically build significant confidence among investors and market participants. There is a form of validation behind breakouts. That is, when the price breaks through a resistance level, it not only surpasses that level, but also becomes a signal that is accepted by the broader market players. Market participants don't view such breakouts merely as short-term price movements. Instead, they see them as indications of a long-term trend change or the beginning of a large price move. In particular, a breakout at this level may indicate the breaking of a strong support or the overcoming of a significant barrier. When prices break through this critical level, it grabs the attention of investors who are looking to make more buys. The increased buying pressure not only pushes prices higher, but also accelerates the momentum. This is because, after such a breakout, the market typically moves with more positive sentiment, and more investors start moving in the same direction. These types of technical analysis breakouts often have a psychological impact at a certain level. This is because investors typically view a breakout of a level as a sign that the market cannot hold at that level and will move toward higher price levels. This psychological effect drives price movements not just based on technical factors, but also on market sentiment. In other words, a technical breakout is not just a chart event, but also a factor that influences investors' decisions and guides their buying and selling actions. If the price breaks this level, it could open a window of new opportunities for many investors. Technical analysts and traders may set higher targets after the level is breached. Such breakouts also signal an increase in market liquidity, with more players entering the market. As new entries accelerate, prices gain momentum, and the uptrend strengthens. If this trend breaks, we will be one step closer to an all-time high. But it's important to note that simply looking at trends isn't enough. We must also consider other metrics. Keep watching. In Elliott wave theory, the fourth wave is typically considered a type of pullback or corrective movement. This wave allows the market to become more balanced after the overpricing of the previous third wave, serving as a healthy correction. During the fourth wave, although prices generally show some decline, this movement is part of the natural cycle of the market and represents a transitional phase. Investors may be more cautious during this period because, after the fourth wave, the upcoming fifth wave tends to gain significant momentum, and many investors wouldn't want to miss out on this opportunity. This corrective phase is a time when investors may act more cautiously emotionally, and there could be some uncertainty in the market. However, this situation actually presents a potential opportunity. The fourth wave correction typically creates an area where prices are unlikely to drop further, setting the stage for a major rise during the future fifth wave. Investors can take advantage of this period by making purchases at the right points, positioning themselves to benefit from the significant rally in the upcoming fifth wave. One of the core principles of Elliott wave theory is that each wave completes the previous wave and sets the stage for the next one. Therefore, the fourth wave can be seen as preparation for the fifth wave's beginning. After the fourth wave correction is completed, the fifth wave typically brings a strong price movement and buying pressure. This movement can accelerate as optimism in the market grows and investors become more willing to take on risk. At the start of the fifth wave, there is usually strong momentum to push prices above the peak of the third wave. This rally can create a psychological state known as FOMO, fear of missing out, where investors see prices rapidly increasing and begin to buy more to avoid missing potential gains. This can increase the momentum of the fifth wave and push prices even higher. Since the fourth wave is often the most anticipated phase of the market correction, investors closely monitor this period. When the fourth wave ends and the fifth wave begins, a rapid upward trend may occur. This rise is strongly connected not only to technical analysis, but also to market psychology. Investors tend to buy more as the fourth wave nears its end, hoping to capitalize on the profits offered by the upcoming fifth wave. Especially at the start of the fifth wave, this wave is typically characterized by a powerful movement that drives prices to new highs. However, when this wave begins, it is important for investors to avoid excessive optimism and pay attention to risk management. The fifth wave usually peaks at a certain point and ends, after which the market may enter a new corrective phase. Another important feature of Elliott wave theory is that each wave contains smaller subwaves within it. So, when the fifth wave begins, it consists of smaller subwaves. These subwaves can create opportunities for investors, as prices may make smaller corrections within these subwaves. Investors can use these small corrections to find better buying points and wait for prices to rise until the peak of the fifth wave. When the fifth wave completes, the price will have reached an all-time high, thus retesting the 88th. At this point, the bullish order block at the current price level presents a strong signal that could potentially change the direction of the market. The importance of the order block is not limited to the price reacting from this level alone. Additionally, the fact that this level has been tested multiple times before, and each time there has been a strong response, causes it to become a type of psychological support level. This creates a critical opportunity for investors and traders, as it is often observed that the market tends to reverse at such support levels. If the price reacts as expected at this level, it will not only signal the start of an uptrend, but also break the current downtrend. Breaking a downtrend helps restore confidence in the market and typically leads to the initiation of new buying waves. Such technical breakouts can be interpreted by traders as either a bull trap or the beginning of an uptrend. Therefore, if the price starts moving strongly upwards from here, it will create a positive atmosphere among market participants. Furthermore, the fact that the bullish order block represents a critical level means that the breakout of this level will have an even stronger impact. This means that not only will the current downtrend be broken, but previous resistance levels must also be surpassed. If these levels are broken, the market could move towards previously unseen new highs. In this case, a momentum gain will begin, and investors will likely start buying to capitalize on these opportunities. Additionally, a strong response forming above the bullish order block could create a safe buying zone for investors. This will provide a solid foundation for the market to enter an uptrend. Such reversals are often not just short-term, but may signal long-term trend changes. Investors should not overlook these opportunities because the first steps of an uptrend are often taken at these strong technical levels. It will be very important for investors to monitor the validity of the bullish order block, adjust their strategies accordingly, and time their buys appropriately. At this technical level, market movements could accelerate, as most investors will likely see a new buying opportunity and position themselves if the price returns to this support zone and reacts positively. If the bullish order block is strongly tested and the price responds strongly from this level, it will not only mean the break of the current downtrend, but it will also allow the market to enter an entirely different path, a bullish trend. We need to observe how the market will react from here. Currently, a short-term downtrend is observed in the RSI indicator. This trend indicates that the price has been in a downward movement for a certain period and signals that the market is weakening. However, the breakout of such a downtrend is typically seen as an important reversal signal. If the RSI breaks this downtrend, it could have a positive effect on the market, as it might suggest that the price will also break its own downtrend. Breaking this downtrend in the RSI is, in fact, an indicator of a shift in market strength. It shows that buyers are starting to re-enter the market and selling pressure is beginning to decrease. If the RSI breaks the downtrend line to the upside, this could be an important technical signal for market participants. In this case, it would be expected that the price would also break its downtrend in a similar fashion and potentially begin an upward move. A breakout like this in the RSI generally indicates that the market is starting to recover from. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.